Question 1. An individual holds a variable life insurance policy. Which of the following statements correctly describes the death benefit of this policy? A. The death benefit is fixed and guaranteed, while the cash value fluctuates. B. The death benefit may increase or decrease, but it will never fall below a guaranteed minimum. C. The death benefit and cash value both fluctuate based on the performance of the separate account, with no guarantees. D. The death benefit is paid out as a lump sum based on the initial face amount, regardless of investment performance. Answer: B. The death benefit may increase or decrease, but it will never fall below a guaranteed minimum. Variable life insurance policies feature a death benefit that can fluctuate with the performance of the underlying investments in the separate account, but it is designed with a guaranteed minimum death benefit. This provides a safety net, ensuring that even if the investments perform poorly, the policy will still pay out at least the original face amount. The cash value, however, is not guaranteed and can fluctuate significantly based on investment performance. Always remember that variable life policies offer potential for growth but carry investment risk, which is why a guaranteed minimum death benefit is a key characteristic. Question 2. A policy owner decides to surrender their whole life insurance policy for its cash value. Which non-forfeiture option is the policy owner exercising? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. When a policy owner surrenders a whole life insurance policy for its cash value, they are utilizing the cash surrender value non-forfeiture option, which terminates the policy in exchange for its accumulated cash value. This option provides the policy owner with a lump sum of money, minus any outstanding loans or surrender charges, effectively ending all coverage. It's important to understand that electing the cash surrender value means giving up the life insurance coverage entirely. Question 3. A policyholder has a life insurance policy with a guaranteed interest rate on the cash value and a flexible premium payment schedule. The policy allows the policyholder to increase or decrease the death benefit. What type of policy does this individual most likely own? A. Whole life. B. Universal life. C. Variable universal life. D. Interest-sensitive whole life. Answer: B. Universal life. Universal life insurance policies are characterized by their flexibility in premium payments and death benefits, as well as a cash value component that earns a guaranteed minimum interest rate. The ability to increase or decrease the death benefit and to adjust premium payments are key features that distinguish universal life from traditional whole life, which has fixed premiums and a guaranteed death benefit. While variable universal life also offers flexibility, its cash value is tied to separate account performance, not a guaranteed interest rate. Question 4. An insurer is determining the premium for a new life insurance policy. Which of the following factors would not be a primary consideration? A. Mortality tables. B. Interest earnings on premiums. C. Policy owner's net worth. D. Insurer's operating expenses. Answer: C. Policy owner's net worth. An insurer calculates premiums based on three primary factors: mortality, the likelihood of death based on age and health, using mortality tables, interest earnings, income the insurer expects to earn on invested premiums, and expenses, the cost of operating the business and servicing policies. The policy owner's net worth is not a direct factor in determining the actuarial risk or cost of insurance coverage. It typically only matters for determining insurable interest or appropriate policy size. Understanding these core components helps clarify why certain information is requested during the application process. Question 5. A policy owner wants to ensure that if she dies, her life insurance policy proceeds will be distributed to her beneficiaries over a period of 20 years, rather than in a lump sum. Which settlement option should she choose? A. Fixed amount option. B. Interest only option. C. Fixed period option. D. Life income option. Answer: C. Fixed period option. The fixed period option allows the policy proceeds to be paid out in equal installments over a specified period of time, such as 20 years, until the funds are exhausted. This option ensures that beneficiaries receive regular payments for a predetermined duration, providing a steady income stream. The fixed amount option pays a specific dollar amount until the proceeds and interest are depleted, while the interest-only option holds the proceeds and pays only the interest, and the life income option pays for the life of the payee. Question 6. All of the following are generally excluded from coverage in a standard individual life insurance policy, except A. Suicide within the first 2 years of policy issuance. B. Death resulting from war. C. Death while engaging in a prohibited hazardous occupation. D. Death due to an aviation accident while a fare-paying passenger on a commercial flight. Answer: D. Death due to an aviation accident while a fare-paying passenger on a commercial flight. Most standard individual life insurance policies include a suicide clause, which typically excludes coverage if death occurs by suicide within the first 2 years of the policy. Similarly, war clauses and hazardous occupation clauses are common exclusions that limit coverage for deaths under specific dangerous circumstances. However, death resulting from an aviation accident while traveling as a fare-paying passenger on a commercial flight is generally covered, as this is considered a common form of transportation and not a hazardous activity warranting exclusion. Question 7. An applicant for a life insurance policy is found to have a severe, untreatable medical condition. The insurer issues the policy but at a higher premium rate and adds a specific exclusion for this condition. This policy is issued on what basis? A. Standard. B. Substandard. C. Preferred. D. Declined. Answer: B. Substandard. When an applicant presents a higher-than-average risk due to health conditions, hazardous occupations, or dangerous hobbies, the insurer may issue a policy on a substandard basis. This means the policy is issued with modifications, such as an increased premium, rated policy, or specific exclusions, to account for the heightened risk. Preferred indicates a lower-than-average risk, standard indicates average risk, and declined means the insurer refuses to offer coverage at all. Question 8. A policy owner stops paying premiums on their whole life policy. The cash value is used to purchase a term policy with a face amount equal to the original policy's face amount for as long as the cash value will permit. Which non-forfeiture option was automatically selected? A. Cash surrender value. B. Reduced paid up. C. Extended term. D. Automatic premium loan. Answer: C. Extended term. The extended term non-forfeiture option uses the policy's cash value to purchase a single premium term life insurance policy with the same face amount as the original whole life policy for a specified period. This is often the default option if the policy owner does not choose another non-forfeiture option when premiums cease. In contrast, reduced paid up uses the cash value to purchase a smaller amount of paid up whole life insurance. Question 9. An agent explains a variable life insurance policy to a potential client, emphasizing the potential for high returns but failing to mention the investment risks and fluctuations in cash value and death benefit. This action is considered A. Twisting. B. Churning. C. Unfair discrimination. D. Misrepresentation. Answer: D. Misrepresentation. Misrepresentation involves making false statements or omitting material facts about an insurance policy's terms, benefits, or conditions to induce a sale. In this scenario, the agent is misrepresenting the variable life policy by highlighting only the positive aspects, high returns, while deliberately omitting crucial negative aspects, investment risks, fluctuating values. Twisting is replacing an existing policy with another based on misrepresentation, and churning involves replacing a policy to generate new commissions, neither of which fully describes the agent's action here. Question 10. According to Florida law, what is the minimum free look period for a newly issued life insurance policy? A. 10 days. B. 14 days. C. 20 days. D. 31 days. Answer, B. 14 days. In Florida, newly issued individual life insurance policies, excluding variable contracts, must provide a minimum free look period of 14 days. This allows the policyholder to review the policy after delivery and return it for a full refund of all premiums paid if they decide it's not suitable. For variable life insurance, the free look period is 10 days, but for standard individual policies, it is 14 days. Question 11. Which of the following best describes the per capita designation for beneficiaries? A. The death benefit is paid to the named beneficiaries who are alive, equally, regardless of their relation. B. The death benefit is paid to the surviving members of a class of beneficiaries, but only if all named beneficiaries are deceased. C. The death benefit is paid to the named beneficiaries, and if one predeceases the insured, their share passes to their heirs. D. The death benefit is paid only if the primary beneficiary and contingent beneficiary are both deceased at the time of the insured's death. Answer, A. The death benefit is paid to the named beneficiaries who are alive, equally, regardless of their relation. The per capita designation means, by the head or, for each person. When beneficiaries are designated per capita, the death benefit is divided equally among only those named beneficiaries who are alive at the time of the insured's death. If a named beneficiary predeceases the insured, their share is forfeited and redistributed among the remaining living per capita beneficiaries, rather than passing to their heirs, which would be per stirpes. This ensures an equal distribution among the surviving primary beneficiaries. Question 12. A policy owner makes a one-time, lump sum payment to an insurance company and, in return, receives a guaranteed income stream that begins immediately and continues for the rest of their life. This arrangement describes A. Single premium whole life policy. B. Deferred annuity. C. Immediate annuity. D. Variable annuity. Answer, C. Immediate annuity. An immediate annuity is purchased with a single, lump sum premium and begins paying out income immediately, or within one payment period, typically within 12 months. This option is designed for individuals who have already accumulated a sum of money and want to convert it into a guaranteed, regular income stream during their retirement years. Deferred annuities, in contrast, have an accumulation period before payments begin. Question 13. Which of the following is not a characteristic of a group life insurance policy? A. Coverage is typically provided as annual renewable term. B. Individual certificates of insurance are issued to employees. C. Policy premiums are based on the average age and sex of the group. D. Individual underwriting is performed for each member of the group. Answer, D. Individual underwriting is performed for each member of the group. Group life insurance policies are typically underwritten based on the characteristics of the entire group, not on individual members. This means that individual medical exams or health questionnaires are generally not required, which is a major advantage for individuals who might not qualify for individual coverage. The coverage is usually annual renewable term, employees receive certificates of coverage, and premiums are based on the group's demographics, making group underwriting a defining feature. Question 14. An insured passes away due to a heart attack 1 year after purchasing a life insurance policy. During the application process, the insured had knowingly misrepresented a pre-existing heart condition. What will the insurer most likely do? A. Pay the full death benefit as the policy has been in force for 1 year. B. Pay a reduced death benefit, proportionate to the actual premium that should have been paid. C. Deny the claim and void the policy due to misrepresentation within the contestable period. D. Refund all premiums paid and terminate the policy. Answer: C. Deny the claim and void the policy due to misrepresentation within the contestable period. Most life insurance policies include a 2-year contestable period, during which the insurer can contest a claim and void the policy if it discovers material misrepresentations on the application. Since the insured died within 1 year, within the contestable period, and knowingly misrepresented a pre-existing condition, the insurer has the right to deny the claim and void the policy. This clause protects insurers from fraudulent applications. Question 15. The payer benefit rider on a juvenile life insurance policy states that if the payer, e.g., parent, dies or becomes disabled before the child reaches a certain age, the premiums will be waived. This rider is designed to A. Increase the policy's cash value more rapidly. B. Protect the policy against lapse due to the payer's inability to pay premiums. C. Allow the child to take over premium payments at an earlier age. D. Provide an additional death benefit to the payer's estate. Answer: B. Protect the policy against lapse due to the payer's inability to pay premiums. The payer benefit rider is specifically designed for juvenile life insurance policies. It ensures that if the person responsible for paying the premiums, the payer, dies or becomes totally disabled, the premiums on the child's policy will be waived until the child reaches a specified age, e.g., 21 or 25. This rider prevents the policy from lapsing and guarantees that the coverage remains in force despite the payer's unforeseen circumstances. Question 16. Which dividend option allows the policy owner to use the dividends to purchase additional coverage that is separate from the base policy and will be paid in addition to the face amount if the insured dies? A. Paid-up additions. B. Cash payment. C. Accumulate at interest. D. Reduce premium. Answer: A. Paid-up additions. The paid-up additions dividend option uses the policy dividends to purchase small, single-premium, paid-up whole life insurance policies. Each addition has its own cash value and death benefit, which are added to the original policy's values. This option allows the policy owner to increase the policy's face amount and cash value without having to pay additional premiums. Question 17. An applicant for a life insurance policy has a specific medical condition. The insurer's underwriting department requests a medical information report, MIB, from the Medical Information Bureau. The primary purpose of the MIB is to A. Provide the insurer with the applicant's credit history. B. Alert insurers to adverse medical information and deter fraud. C. Determine the applicant's lifestyle and avocations. D. Offer a summary of the applicant's employment history. Answer: B. Alert insurers to adverse medical information and deter fraud. The Medical Information Bureau, MIB, is a non-profit trade organization that maintains a database of confidential medical information on applicants. Its primary purpose is to act as a clearinghouse for information that helps insurers detect and deter fraud by comparing information provided by applicants with records from previous applications. The MIB report alerts insurers to medical conditions or health impairments that might have been undisclosed or inaccurately reported, ensuring more accurate risk assessment without revealing detailed medical records. Question 18. An insurance company is licensed to transact insurance business in Florida. In Florida, this company is considered a alien insurer. B. Foreign insurer. C. Domestic insurer. D. Authorized insurer. Answer: D. Authorized insurer. An authorized insurer is an insurance company that has been granted a certificate of authority by the Department of Financial Services, DFS, in Florida, allowing it to legally transact insurance business in the state. Whether an insurer is domestic, domiciled in Florida, foreign, domiciled in another U.S. state, or alien, domiciled in another country, is a classification based on its place of incorporation, but the term authorized specifically refers to its legal ability to operate in a given state. Question 19. Which life insurance policy type requires the policy owner to possess securities licenses in addition to a life insurance license to sell? A. Whole life. B. Universal life. C. Variable life. D. Interest-sensitive whole life. Answer: C. Variable life. Variable life insurance policies invest premiums into a separate account, often comprised of stocks, bonds, and money market instruments, where the cash value and death benefit, above a minimum, fluctuate based on investment performance. Because these policies are considered securities, agents selling variable life products must hold both a state life insurance license and a securities license, e.g., FINRA Series 6 or 7. Other traditional life insurance policies do not involve direct investment in securities by the policy owner, thus not requiring securities licenses. Question 20. An insured takes out a loan against the cash value of their life insurance policy. If the insured dies with an outstanding policy loan, how will the death benefit be affected? A. The death benefit will be reduced by the amount of the outstanding loan plus any accrued interest. B. The death benefit will be paid in full, and the insurer will pursue collection of the loan from the estate. C. The death benefit will be delayed until the loan is fully repaid by the beneficiaries. D. The death benefit will be forfeited entirely, as the loan constitutes a breach of contract. Answer: A. The death benefit will be reduced by the amount of the outstanding loan plus any accrued interest. When a policy owner takes a loan against their life insurance policy's cash value, the loan reduces the amount payable at death. If the insured dies with an outstanding policy loan, the insurer will subtract the amount of the loan, plus any accrued interest, from the death benefit before paying the remainder to the beneficiary. This ensures that the loan is repaid and the insurer is not out of pocket, while still providing the remaining coverage to the beneficiary. Question 21. All of the following are typically characteristics of a participating life insurance policy, except A. Policy owners may receive dividends. B. Premiums are generally higher than non-participating policies. C. Policy owners have a voice in the company's management through voting rights. D. Dividends are guaranteed and taxable to the policy owner. Answer: D. Dividends are guaranteed and taxable to the policy owner. Participating life insurance policies are issued by mutual insurance companies and allow policy owners to participate in the company's divisible surplus through dividends. While dividends are a key feature and policy owners often have voting rights, dividends are never guaranteed and are generally considered a return of unearned premium, thus not taxable to the policy owner up to the amount of premium paid. Premiums for participating policies are typically higher to account for the potential return of dividends. Question 22. What is the primary purpose of the Florida Life and Health Insurance Guaranty Association? A. To regulate insurance rates and policy forms in Florida. B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. C. To promote competition among insurance companies in Florida. D. To resolve disputes between policyholders and agents. Answer: B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. The Florida Life and Health Insurance Guaranty Association, FLIGA, is a statutory entity created to protect policy owners, insureds, and beneficiaries of life and health insurance policies and annuities from financial losses due to the insolvency, failure, of an authorized insurance company. It provides coverage for covered claims up to certain limits when an insurer is unable to meet its obligations. This association acts as a safety net, funded by assessments on solvent insurers. Question 23. An individual purchases a decreasing term life insurance policy. Which of the following statements about this policy is true? A. The death benefit remains level throughout the policy term. B. The premium decreases each year as the death benefit decreases. C. The death benefit decreases over the policy term, while the premium remains level. D. This policy builds cash value over time. Answer: C. The death benefit decreases over the policy term, while the premium remains level. Decreasing term life insurance policies are designed so that the death benefit gradually decreases over the policy's term, while the premium typically remains level. This type of policy is commonly used to cover a decreasing financial obligation, such as a mortgage, where the amount of coverage needed declines as the debt is paid off. Term insurance, by definition, does not build cash value. Question 24. A policy owner changes the beneficiary designation on their life insurance policy from revocable to irrevocable. What is the main implication of this change? A. The policy owner can no longer take out a loan against the policy's cash value. B. The policy owner can change the beneficiary again only with the consent of the current irrevocable beneficiary. C. The policy owner is no longer responsible for paying the policy premiums. D. The policy's cash value immediately becomes accessible to the beneficiary. Answer: B. The policy owner can change the beneficiary again only with the consent of the current irrevocable beneficiary. Designating a beneficiary as irrevocable means the policy owner cannot change the beneficiary, assign the policy, or take out a policy loan without the written consent of that named irrevocable beneficiary. This provides a high degree of security for the beneficiary, as their right to the policy proceeds cannot be unilaterally altered by the policy owner. It essentially gives the irrevocable beneficiary a vested interest in the policy. Question 25. An insurer issues a policy that offers a guaranteed minimum death benefit, but the cash value and potentially higher death benefits are dependent on the performance of a separate account. This policy is A. Whole life policy. B. Universal life policy. C. Variable life policy. D. Equity indexed life policy. Answer: C. Variable life policy. Variable life insurance policies are distinctive because their cash value and the potential for a higher death benefit are directly tied to the performance of an underlying separate account, which invests in equities, bonds, or money market instruments. While the cash value fluctuates and is not guaranteed, these policies typically provide a guaranteed minimum death benefit to ensure a baseline level of coverage. This blend of investment potential and a guaranteed floor is characteristic of variable life.